Hi, everyone, and welcome to The X, a podcast from inside Silicon Valley about how experience shapes everything, from products to services to entire businesses. I'm Brian McLean, and I'm here with Demetrius Madrigal. Today, we're going to talk about the stock market, investing, the GameStop event, and how the latest tools, such as Robinhood, are using user experience to engage younger investors and changing the system as we know it. Hey, D, how are you doing today?
I'm doing pretty good. How are you doing?
Pretty good. I was wondering, how is your GameStop and AMC stock doing today?
They are not existent because I steered completely clear of all of this because it's so unpredictable right now.
Wow, this has been a crazy couple weeks, and I'm glad we're actually doing a podcast on this topic because there's a lot of things to talk about. It's not just those events, but it's also how those events kind of came about and the evolution of online trading starting, in the 90s until here we are today. And we're going to talk about all that stuff. But I wanted to mention actually, Dee, before we get into this, that we're not telling anyone what to do with their money on this podcast. And I want to be clear to all of our listeners. We are simply diving into these big topics on finance and investing to help you think objectively about them and kind of give you a historical breakdown from a user experience perspective of how we got to where we are today. So I just wanted to point that out just to make sure everybody knows that we don't want you to necessarily take our information and our advice and use it when it comes to your personal finance investments. So with that said, and that put aside, I wanted to start off here, Dee, by talking a little bit about my experience with online investing early on, like back in 1999, and kind of what I saw then and what I'm seeing right now. Does that sound good?
Yeah, absolutely. Things have changed a great deal.
Yeah, they have. So I actually started on E-Trade, and I think it was before 99. It might have been like 98. It was right when E-Trade was becoming more popular and online trading was starting to emerge. And when I first started on there were some articles written back then even saying like, oh no, this is going to be trouble. We're like allowing people to quickly get on their computers and make trades. And I remember there being a little bit of that happening then. But there was definitely some walls put up, especially, excuse me, in front of me. And for example, I couldn't borrow on leverage back then. Like I was not considered an accredited investor. I didn't have enough money. I had barely any money actually back then. So if I tried to go in and borrow money from E-Trade as kind of like a bank and then use that money to invest, the answer would be no. And I even looked into that back then just because I was curious about it. I wasn't going to do it, but I was curious about it. Back then, I needed $1,000 to start investing. So the first thing I had to do is save enough money to get the $1,000 in there in order to even make my first trade. I was also not allowed to invest in stocks before the market opened. So one of the things I tried to do back then was I tried to call E-Trade, tell them, hey, I want to invest in this company that's going public tomorrow. I don't have pre-IPO shares, but I'd like you to place my purchase option now so that the minute the stock market opens, you're going to try to engage on that trade, right? Like basically make that trade a reality.
Yep.
And they wouldn't allow me to do that either. And the reason why they wouldn't allow me to do it was because of the possibility that the second that the market opened, that stock would tank, I would lose all my money. And that was kind of a protection they put up due to the fact that I didn't have the income level necessary to allow that to happen. Nowadays, almost all of these things are kind of gone. So for example, you can invest very, very small amounts of money. So you don't need to have that minimum $1,000. You can buy fractions of shares. Back then, I couldn't buy like a percentage of a share. I had to buy an entire share. So if the share cost more than the amount of money I had in my account, I couldn't buy a share. Borrowing money now, I guess, is easier than it ever has been. Basically, borrowing on leverage, something that I couldn't do. And also, you can buy pre-IPO shares from third-party exchanges, which is something that I couldn't do back then either. So, like for example, if I wanted to get in on a new company that was going public like Amazon, I had to either apply to buy pre-IPO shares and hope I get selected, or I had to wait till the market opened and then purchase those shares. Where now you can actually go to these third-party exchanges and buy shares from people who actually work at the company who want to sell their shares before it goes public.
Yeah, it's very interesting how much things have changed. It's especially kind of that third-party exchange for pre-IPO shares. We know from working with startups, there's a lot of language in option grant contracts and things that heavily discourage that kind of thing. So it's kind of fascinating how the market is evolving in response to user demand.
So there's a couple sides to this, D. So on one camp, it's basically like, don't lower the barriers to entry because you're basically setting people up for potential failure, right? Like don't lend them money, don't let them buy shares unless they have a certain amount of money in the bank, that kind of stuff. Like protect these people a little bit. Then there's the other camp, which is like, no, lower the barriers to entry, make it really easy to get into the stock market and allow people who don't have a lot of money to get in and start playing a little bit around, making mistakes, learning, that kind of stuff, so they can contribute some of their money and hopefully see an upside over time in the market. Like, where do you stand basically when it comes to this?
I can see both sides of the argument. One of the challenges is in our current world, the only real way to get to a real financial security and to be able to retire is to have investments going. Something that's going to bring you passive income after you retire, because otherwise you can get wiped out very quickly by like a medical emergency or something like that. On the other side of things, it's kind of created a little bit of a wild, wild west where it's extremely unpredictable. The rules that govern kind of trading have been turned upside down. And there's a lot of illegal activity going on that is not being enforced because the SEC is probably not sufficiently funded, and the rules around prosecuting a financial crime are much different than like a street level crime.
Yeah, I mean, I got to tell you, like this time right now, and we'll talk about the GameStop event in a moment here, and I'll try to break it down for everyone. I'm not going to have every detail correct here, but like I'll give everyone a general understanding of what happened and what we think happened. But it feels a little bit like 1999 when a lot of people believed that no matter what, if a company went public, you'd make money on it. And I actually have a story that I'd like to share that's very specific to this. And I think about this story a lot, and it might be helpful for people who are listening. So back in the late 90s, I was working for a tech company. I was just getting started with my career, and I went to a trade show, and it was a big trade show, and we were presenting there, and I met some people at this other booth, and I was just chatting with them, and I think we were all going to have dinner that night or something. And one of the guys from there was an accredited E-Trade investor, meaning he had I think it's over $50,000 or something like that. I don't remember what the number was back then. And he showed me how he was investing into a pre-IPO company that was going public that day while we were at the event. And so he had bought shares in that company through E-Trade prior to this event. So you were able to apply. And then if they accepted you, then you tell them, okay, here's how much money I want to invest. Most people would put the most amount of money they can possibly put into it. And then the company would go public, and you'd hope that the price would go up. But this was before the dot-com boom and then bust. And everyone was just like all on board. Anything that was a .com was going to do well in the stock market. So he made some sort of investment. I don't know how much it was, but he quickly showed me, oh my gosh, look, the market just opened. Come take a look. And I went and looked at his laptop, and I didn't really know this person. He was just showing me. Maybe he was showing off. I'm not sure. And it bumped up enough that he made $50,000 in like 5 minutes. And then he just instantly sold it all. And he was like, that's awesome. All right, let's go back to the trade show. Like it was like in a moment, I'm like watching someone make 50 grand at the snap of a finger. And everyone that was around him and everything was like, oh yeah, we're totally into this. We're trying to get all these pre-IPO shares. And it was like a mania around it. Like you can make tons of money really quickly by just logging into E-Trade really quickly and executing these trades when the company goes public. It feels right now like that, right? Like when I hear about all the stuff with GameStop and how people are day trading like crazy, or I even read some articles about people who used to gamble a lot in the sports area who are now gambling in the stock market area because, it's available and it's in front of them. And I just start getting those feelings again.
Yeah, definitely. I think if you look at some of the data, and we could talk about some of that data, to me, it looks quite a bit like a bubble. And it's not just a bubble in the stock market. It feels like a bubble across all financial investment right now, from real estate to cryptocurrencies, just kind of across the board.
Yeah, everyone's really kind of dumping in to the market, and who knows? I mean, the market fundamentals might be doing quite well, because we have a vaccine and coronavirus hopefully can be under control within the next year or something like that. But
Yeah.
it's just a feeling. I don't have any data
Yeah.
behind it, but it
There
is a
is something
feeling.
to keep in mind as we're talking about all of this. The U.S. economy entered a recession in February of last year, so that's about a year ago. Most recessions last around 18 months. So aside from and keep in mind that the first lockdowns because of the pandemic didn't start until March. So we entered a recession before any of the economic lockdowns. So this entire time, despite what the stock market has been showing us, we have been most likely within a recession and will continue to be so for a little while longer. That's not just a result of the pandemic.
Yeah, and so there's a lot kind of going on there, and I want to talk about the GameStop event because I feel like it really kind of highlights what's going on, and then that really will lead into us talking about how user experience plays a big role in this and how product plays a big role in this. So I'm going to kind of summarize here for everybody. I don't have every detail perfectly, but I just want to kind of frame it up. So basically, in April 2020, Michael Burry, which he used to own Cyan Capital, I believe he sold that company already. He was one of the key people in The Big Short. Like if anyone saw the movie The Big Short, because he basically shorted the market.
He predicted the mortgage crisis in 2008.
Correct. Yeah. And so he bought 5.3% of the GameStop shares at about $204 a share, which was about a $15 million investment. And what he was looking at was the fact that GameStop, he believed, was undervalued because they're transitioning to be a more digital company, and a lot of the consoles that are coming out still have disk drives in them. So he looked at it and said, okay, well, I think there's some upside here, right? It was not expected to turn a profit until about 2023. So he was looking at this as a multi-year investment.
Mm-hmm.
So other investors, different investors, hedge funds and stuff, they saw the writing on the wall for GameStop, as most people are downloading their video games rather than buying them in store. And GameStop is primarily a retail company, and they decided to short the company. So I believe a lot of people are very confused about what short selling is. So I just want to explain it in the simplest terms I possibly can. So basically what you do is you borrow shares and you pay a fee for this from a large institution. Then you go and sell them right away. You wait for the price to fall. You buy back those same shares. Well, not exactly the same shares, but you buy back the shares. You give those shares back to the lender, and then you pocket the difference. It's like the spread. So for example, you borrow shares at $10 a share from, some big institution. Then you sell them. You buy them back when the stock drops to, let's say, $5 a share. You give them back the shares you borrowed, and you keep the remaining $5 per share for yourself, minus, your fees that you pay. So when you're short selling, I mean, it's definitely a risky investment, because if the stock does not go down, you have to buy back the shares at a much higher price. Well, individual investors, part of this Reddit page called WallStreetBets, decided to buy into the stock because they both thought it was undervalued and it was a heavily shorted stock in the market. In fact, there were more short contracts than there were actual stock available, which kind of set the stage for the short squeeze. What also helped on this was that Redditors bought en masse to boost the price, and then got promotions from people like Elon Musk and Chamath, who's a big investor, because they jumped in and were part of this as well. So the dramatic rise in the price basically forced the short sellers to cover their losses by buying more GameStop stock. And this is called a short squeeze. And basically, it drove up the price of the stock. So the people who bought in at like $2, $3, $4 a share, suddenly the stock's skyrocketing to, I think it went up to like $430 a share or something like that. And at the same time, the short sellers couldn't buy back the stock at a cheaper price to give back to the institutions that they purchased it from. They had to start buying the stock at a much higher price, which means that they lost a ton of money. And the people who bought in at the lower price ended up making a ton of money.
Yes.
Right. And so that's basically what happened, right, D?
Yeah. One of the factors that happens here is that once the short squeeze is basically what happens with the short squeeze is that as the stock is going down, or as the stock is going up while the shorts are depending on it going down, the only way they can cover their losses is to buy the stock and ride it as it goes up. That way they're gaining money to cover their losses. So theoretically a short can lose you almost an infinite amount of money, right? If you shorted a stock expecting it to go down to $2 and it goes to, $1,000 a share or something, you're out all of that money. The alternative is if you bought into the stock at $10, hoping it would go down to $5, and instead it goes to $100, hopefully you can buy in at $20. That way, that difference between $20 and $80, you make back, and then you've only lost $10 a share as opposed to $80 a share.
Yeah, and as you can see, it gets complicated very quickly, and it can be very expensive if you make the wrong trades. And There's also another twist to this. And D, why don't you explain what happened with the trading app Robinhood that most of the retail investors, individual investors like Demetrius and myself, what happened when they were using that particular app in order to make their purchases?
So for reasons that are currently unclear, there's probably some interviews and things of them saying some of the reasons why. Robinhood, partially because they could not cover the losses from all of the selling, right? Because they're kind of a financial intermediary. They halted retail investors, individual investors, from buying more Robinhood stock, and that caused the stock to start going down because you're removing a great deal of demand in the market, right? You're preventing all of these motivated buyers from buying the stock, so the stock, by kind of supply and demand, because you're cutting out demand, starts to go down. Now, that might have been illegal, especially if it was done for the purpose of making the stock go down so that they can help out their institutional investors to exit their short positions without taking too much of a loss. So that's likely to have an SEC investigation opened up, especially with pressure coming from both the left and right of the political spectrum. You've got Ted Cruz and Donald Trump Jr. Agreeing with Bernie Sanders and AOC that this was unacceptable. And one of the reasons why they're seeing it as unacceptable is that while the retail investors, the individuals, were locked out of trading on GameStop and AMC and some of these other stocks, the hedge funds and other institutions were free to continue trading and exit their positions.
Yeah. I mean, I think one of the bigger questions is it illegal to do a short squeeze?
That is a little tricky. So first off, there's illegal actions all around. Number one, when shorts are being sold and there's no actual stock behind it, when you have more shorts sold than there are actually stock to cover that, it's called a naked short, and it's illegal, right? That shouldn't be allowed to happen. And for whatever reason, they haven't really taken action against it. And you can speculate to all kinds of reasons, but the reality is there should not have been more shorts available than stocks available. And it's one of the reasons why the short squeeze was so effective, because it was literally impossible for these institutional investors to buy enough shares of GameStop to cover their losses. The other part of the thing is that for a short squeeze, if it's done deliberately, it can be considered market manipulation, which is illegal. And then because by law, you're supposed to base purchasing decisions on the financials of the company itself rather than any attempt to manipulate the value of the stock, right? The other part of it is if you are coordinating with other people, then that's conspiracy. So that's another charge on top of that. So quite a few of the short squeezes that do happen, they're executed by an institution, which is seen as a single entity. So they're not coordinating across multiple institutions as much. So that can kind of avoid the conspiracy charge and also makes it much more difficult to prosecute. The other side, as we already talked about, is that by Robinhood shutting down the trading or at least the purchasing of more GameStop shares or AMC shares, then that is also potentially market manipulation and could also end up with some federal charges. And the SEC is not strictly a criminal law enforcement agency.
Hmm.
What they can do is they can identify things, they can levy fees, they can strip licenses. But if there can be criminal charges, then it has to be referred to basically the Justice Department and for a U.S. attorney to prosecute. It doesn't happen that often, partially because now you're looking at a huge number of individuals who have engaged in this activity. They're probably just overwhelmed for one thing. For another thing, it might be very difficult to prosecute just because you have to prove that when you were engaging in these activities that were illegal, you knew that they were illegal, and it was your intent to break the law. So that's something that, with potentially thousands and thousands of people engaging in WallStreetBets or associated Reddits or subreddits, that trying to prove that for a large number of those people can be very, very difficult.
Well, I took a look at that Reddit page, Wall Street Bets. I've seen it before, but I've never really kind of dug into it because I don't day trade a lot. But they're very transparent. I mean, they're almost more transparent than like a hedge fund. I mean, people are
Yeah.
taking pictures of the financials of the company and saying like, "Look, it's undervalued here, that." It's like I didn't see anything on there that was like a red flag to me. And I'm not an SEC person, obviously, or an SEC officer, but just looking at it, it just looks like a page, a transparency page where people are just saying like, here's how I'm investing.
Yeah,
And
yeah. I'll have to say that I've seen some things, because if somebody is posting, hey, let's buy GameStop so we can stick it to the hedge funds,
uh
that right there is already market manipulation, and that's
I
an
didn't
attempt
see,
at
I didn't see
conspiracy.
that. I mean, there's a lot of
Yeah,
pages on there, but I didn't see that. I just saw a lot of people posting financials and showing how the company is undervalued.
yeah. That is partially part of the counter argument, is that they believe that it's undervalued, and that even if they are seen to be executing a short squeeze, it's if they are doing it because they believe that it's somehow related to the undervalue, then it's them capitalizing on somebody else's positions. It's not necessarily just to manipulate the market. So that can get very tricky when it comes time to kind of hash out what happened here.
Oh, absolutely. And, I think we should take a step back for a second here and think about how all this actually happened, because I think that user experience plays a huge role in how this all eventually occurred. Not
Yes.
specifically the event, but the market itself getting to a place where we have so many more retail investors than we've ever had. And I think the barriers to entry were dropped quite low when Robinhood came out, because they gamified the platform and also made it very easy to make investments. Now, to be fair, there are other platforms that make it easy to invest, such as the Cash App. You can buy, stocks and I believe Bitcoin on there, and other platforms. But I think what Robinhood did was they basically said, okay, come in and we're going to kind of support you in any possible way that we can to get you up and running and investing. And for some, probably an amazing opportunity. And for others, really put them in a bad position. And it's tied around user experience, because the Robinhood app is a gamified stock trading app, right? It makes it feel so fun. Like when make a trade, you get, some sort of, balloons or whatever it is, like, congratulations, you made this trade, and congratulations, your stock just went up, right? It's like
Yeah.
reinforcing, hey, come on back, play more, do more. But ultimately, when you look at it, and this is just my perspective, is that when you're making an investment into a company, you're investing your money into a whole group of other people growing, building, sustaining, innovating a product or a service. And your belief is that they're going to grow it and it's going to get bigger and bigger and do well. But you don't know those people, and you have to give them time to actually do that if you believe in that company, right? So
Yeah.
quick day trades are really challenging. Even the best day traders that I've ever met said that they have really rough days where they lose a lot of money.
Yeah, absolutely. Well, I think looking at platforms like Robinhood, one of the biggest things to keep in mind is that at the very core of product or service experience are features. What can it do for you? So
Mm-hmm.
that is the number one. It's we keep telling people user experience is not really about interface, right? It becomes an interface is a part of it, but at the very core of design, experience design, is features. So you start with that, and then you work outwardly from that until you get to an actual interface and a backend and everything else. And what Robinhood and similar apps did from a feature perspective is they created new experiences. They enabled new features such as commission-free trades, such as partial stock buying. So this allowed a lot more access to financial markets to younger people that we probably couldn't afford to do when we were in college because we had very small amounts of money to drop into things. That is completely different now that Robinhood and these platforms are available.
Well, commission-free trades alone. I mean, you have a degree in psychology that when somebody has to pay for something to occur,
Mm-hmm.
they spend more time thinking about it than if they don't have to pay. So when someone has to cross over the line and actually hand you money, they are more likely to analyze their decision in a more detailed way than when they're not, right? So when you take away the commission, you say, I'm not going to charge you $5.99 for you to make this trade, then, you feel more compelled to do it all the time.
Yeah. The other big thing, especially for people of this age, because they're in college, they may not have access to as much money yet. The access to leverage that they have is game changing. If we could have gone back to, the 90s or the early 2000s, we're in college, we're looking at everything that's happening in tech. If we could have traded on leverage for a company like Amazon at the time, we absolutely would have done it, but we didn't have access to it. So now that people can do that using what appears to be kind of a largely algorithmic approach to granting leverage for leveraged investing, then it opens up massive new doors.
Oh, absolutely. And I think more and more of these trading platforms are kind of lowering the barrier. But now what they're realizing after, we've had some serious issues, and even one user who very, very sadly took his life because he was so concerned about his losses that actually weren't his losses, right? As we learned later, he just misunderstood the information that was presented to him. That we're trying to put up more guardrails to prevent those things from happening, and also for people just losing their money. Because I think that when I was just starting out in investing, I was reading all these books because I wanted to learn about how you look at a company and like how do you understand their financials and how do you determine if they're a good investment and that kind of stuff. But a lot of that has changed, and you and I had a big conversation about this the other day. A lot of the valuation people are putting on companies now seem to be more brand focused rather than fundamental focused. So
Yeah.
that plays into it as well. Like people want to say, and I think you said it to me, people want to say, I own Tesla or I own Airbnb, right? But do they really understand like how much money they make, how many houses they rent out, right? You know what I mean? And I bet most of them don't.
It does sometimes feel like owning Tesla stock or Amazon stock or Apple stock, or many of the other meme stocks, which is kind of telling that that's even a term nowadays. It feels a little bit like a status symbol of like, hey, I'm in the club. And in general, I think that we're kind of getting to the point where a lot of this is based on brand and based on hype rather than kind of looking at what is a good price for that stock. And I think the outcome is that you have companies like Tesla, which are trading at something like 60 times what the PE ratio is on average. You have Apple, which doubled in value without any increases in revenue from 1 trillion to 2 trillion. It feels as though eventually that it's kind of the nature of brand that it adds value to whatever product it is. And if you consider now stock to be a product, then the brand behind it is going to affect the value of the stock. Now, where this might get interesting is that brand effect is usually something that's relatively static, right? Like Apple has a certain brand value that doesn't change a great deal, and it can, which makes it sometimes a little volatile. But at the same time, the brand effect at some point for the stock price will reach a level of homeostasis, right? So if you consider, if you look at Apple stock, for example, and you say, okay, this is worth, X amount of dollars without brand being considered, right? If it just based on kind of the financials, if it was brand X, and or if you were blind to the brand, then you start applying the brand value to it. Now that is basically a markup, right? So you're getting a markup based on the brand value until it reaches kind of like it will continue going up until it reaches what that markup should be based on its brand perception. Now, unless something happens with the brand perception, that growth should level off there theoretically. But more concerningly, there could be something that happens that causes that brand perception to tank. Maybe Apple or something comes out about Apple that changes how they're perceived, or maybe there's some new flavor of the month that makes Apple look, not that this would actually happen because Apple's been a great company, but a new flavor of the month that makes them kind of irrelevant. So a great example could be Snap, right? Snap is doing really well, and it is a meme stock that is popular with younger investors and to some extent is trading on brand and hype. But at the same time, the financials of the company aren't great. And if something came along and made it really irrelevant, then that stock could dump very quickly.
Yeah, absolutely. From a user experience state of mind or framework, I look at it and I go, okay, now you're managing more than one thing, right? You're managing both the development of great product out of your company, but you're also managing this perception. And that perception has to be very dialed in, and it has to really connect with the customer and has to be on point at all times. I mean, we've seen this with just some of the hearings, regarding monopolies and stuff like that with some of the bigger companies, is that like you can see the stock like fluctuating like as they're communicating during the hearing, right? And I know that's always and I know that's always something that's always occurred like in the past. But the difference is now it's real time. Like you said, so you're like watching it go up and down and everything, and people are trading on that.
And this is all magnified by social media platforms, especially something like Reddit, right? Where now instead of, in the old days, somebody would come to a conclusion, even if it was based on branded, they would make their investments and you might have other people doing the same just organically. But now, because people are communicating about it, you could have specifically coordinated action, like everybody's saying like, hey, everybody buy this and let's make the stock go up. Mm-hmm. Or you can have kind of a follow the leader influence action where you can have like a Michael Burry or an Elon Musk saying, hey, I'm buying into this stock and I'm going to make a bunch of money on it, or look how much money I made on it. And then everybody just kind of follows the leader. That magnifies the influence on the market.
Oh, absolutely. But people have been doing that forever, though. I mean, most astute investors will tell you that they look at the people that they admire the most, like Warren Buffett and others, and kind of just follow what they're doing or have done over the last 20 years.
But that in the days before social media platforms, that could take quite a bit more time to do so. It's not today where you almost have a live feed of that person's investments. The other thing that I think is really interesting is that this pandemic has been going on the whole time during this. So that means that there's a lot less consumer spending on things like gas and cars and restaurants. People are being like, I've bought a lot less clothing, to be honest, because I'm not going out. People aren't spending money on haircuts or chiropractor appointments and things like that. So that's allowed a lot of that money to flow into investment accounts. And it's just like pouring gas on the fire. So a lot of people are out there saving money, like especially younger people, because they're not going out to bars and they're not going to movie theaters and things. So what do with the extra cash? They dump it into their investments, which is smart, right? That's what, the traditional wisdom is. That's what you do, and you invest your money. But what ends up happening is it's created kind of an influx of capital into all of the investment markets, and it's created what I believe to be is basically a bubble across the board. So housing prices have increased because of investors when you expect for them to decrease, especially like in California, right? You hear all of these stories about people fleeing the state because it's so expensive, or they don't have to live here anymore because they can work from anywhere. Housing prices have not gone down. They've stayed steady, and part of that is because all of these investment properties, hedge funds are buying houses. You have individuals buying houses so they can put them on Airbnb and make money that way. It's really kind of floated the housing market, despite the fact that a lot fewer people are buying in this area. Same thing is happening with stocks. So looking at, and according to Business Insider, in 2020, retail investors increased from 10% in 2019 to 25% of the stock market. So that's more than doubled between 2019 and 2020. And a lot of that money has gone into individual stocks, which before, if for individual investors, a lot of them were being pushed into funds, right? So Vanguard funds, mutual funds, that kind of stuff. And instead, a lot of it is going into individual stocks as well as into options. So individual stocks have seen, according to Wall Street Journal, has jumped up 14.9% of trading. Or from 14.9% of all trading to 19.5%.
But I think that ties right back to what you were saying earlier about the brand effect, right? Is the
Mm-hmm.
fact that people, you invest into a Vanguard fund and it has great growth if you look over decade, right? But then if you really want to feel cool, then you're like, oh, I bought Tesla stock, right? Or I bought Apple stock, right?
Yeah,
That's maybe part of that.
yeah, and these companies are doing well, especially for a company like Amazon for Apple, who are providing digital services on the internet. They have done quite well during the pandemic, so it looks like a great purchase. But it's really hard right now to suss out the phrase, a rising tide raises all boats. Basically, because we have all of these younger people jumping into the market, and they have more money than they have more disposable income than they might normally have. That's just pumping a bunch of capital into the market and increasing kind of the cost of everything. It's basically inflation within it. So now you're seeing everything go up in value. And it's hard to tell if that's because just the differential performance of that company relative to its competitors, or if it's just because it's just going up because there's more capital in the market in general.
Well, yeah, because it begs the question of like, once the economy opens up more normally, let's say, I don't know, a year from now or something, 8 months from now, most people are vaccinated and you start seeing people go back and getting their haircuts and doing those types of things. They're going to have less money to invest in the stock market because they're going to be putting it back into services that they had before. What will that do? Like, how will it change things, right? That's still kind of a big question mark, I think, for a lot of people.
Yeah, I think that's one of my biggest takeaways, is that this is all very, very much in flux, and it's very difficult to understand what's going on. It's one of the reasons why, like, I've personally been pretty cautious about this, because it feels like we're in the middle of all of the rules being rewritten. Especially, we've talked about leverage before, but I did a little looking into kind of how the cryptos are doing right now, and one of the things I found is, according to Cointelegraph, there's been a record amount of leverage investing into cryptocurrency in 2020. So what that basically means is that a lot of the crypto purchasers are actually borrowing money in order to buy cryptocurrencies, which is for something that volatile seems very scary to me.
Oh, absolutely. Yeah. And I don't know how all this is going to unfold, but I do want to circle back to what we were talking about earlier, because I think it has a really important point in it. So for the longest time, and I've kind of complained about this, is that I hear from large institutional investors that the only way for retail investors to grow their wealth and become wealthier and more and do better in their life is to invest into the stock market or invest into housing, things like that. And then once we start like lowering the guardrails, and I'm not saying they should be completely down or anything like that, like I definitely want protections, but like we start lowering the guardrails and more retail investors come in, then they start screaming, oh, you're not doing it right, you're not doing it right. Like why aren't you looking at fundamentals? Why are you buying on brand, right? I feel like it's a kind of a changing of the guard a little bit, right? Like I feel like these younger investors are just their lens is different and they're getting in and they want to get in because, it was only in 2008, right?
Mhm.
2009 when we had the huge financial crash and so many people lost everything and had to really suffer through that and are just pulling themselves out. And I think they want to get in on the market and they want to do better. And so you can't have it both ways, right? You can't have
Yeah.
investors investing and then you also complaining that when they're learning and trying new ways of looking at
Mhm.
things and that kind of stuff, that they're doing it the wrong way, right? I feel like this is just the beginning of a changing of the guard a little bit.
Yeah, if you look closely at what they told people, it was get your money to investments, but don't invest in individual stocks. Invest in, our Goldman Sachs or Vanguard or Fidelity fund, which will
Correct.
manage your money for you, and we make money regardless on how your portfolio does. I think that a lot of the traditional wisdom is probably fairly accurate. I think it is very risky to invest in individual stocks. Investing is probably the only real way in order to prepare for the future. And if you look at performance, the funds have been very safe and very steady in general. On the other side of things, it's kind of self-serving for them to say invest, but do it through my organization so we will make money off of you. So that's one of the ways in which it's kind of difficult to make sense of some of these things as far as like what's the reality and what's the truth. But I think I agree with you. We're kind of in the middle of the changing of the guard, and experience has had a major impact. And I think the experience is going to change both because of different decisions that the platforms are going to make, as well as different rules are going to be imposed on them through regulation. So until we see what that is, we're going to have these kind of growing pains. I think that there's going to be instances where people make a lot of money and instances where the same people lose a lot of money because it is so volatile and it is so unpredictable.
Absolutely. Yeah. I mean, do
Yeah.
you expect to see like specific regulation? Like, have you thought deeply about like some of the things that they might want to start putting guardrails around or regulating now that the market is starting to change the way it is?
Well, I think that one thing is that it really, really makes sense to me to get some limits on leverage investing. Like it can very quickly run away with you. People who don't understand it as well, like that one young man you talked about who committed suicide. It feels like there's maybe some kind of intermediary certification between like an actual, licensed and bonded trader and like an individual investor who maybe who's if somebody's completely green to all this stuff shouldn't get access to all of the powerful tools. They should have to go through some kind of education or certification process, even if it's lightweight, in order to get access to some of it.
Oh,
And what they do
absolutely.
with it after that is up to them, but at least they're educated on what some of this stuff means.
Absolutely. And, I look at it and I go, okay, if you're going to buy a house or you're going to refinance a house, I mean,
Hmm.
you got to fill out like 30 pages of paperwork, right? Like
Yeah.
you have to give them every financial detail about your life that exists in order for them to let you borrow the money in order to get a home. And a home is actually like a physical thing, right? That you can live
Yeah.
in, you can sell it, other people can move into it, right? So if you're going to allow people to borrow funds on margin, they should have to deep dive into you a little bit and make sure that you can cover it if you lose it. Right. And
Yeah.
I think those guardrails will be valuable for a lot of people and be clear about what those are. Right. So, like, if you want to borrow $500, it should say, here are the 10 things or 5 things or whatever it is that you need to do in order to borrow $500 from us. If you want to borrow 10,000 from us, here are those things, and if you lose it, here's what it looks like, from a paying it back perspective, right? Of
Yeah.
the steps that you're going to need to take. I mean, I feel like when it comes to UX and user experience, a lot of it is about transparency and communication, right? It's about
Hmm.
making sure people truly understand what they're getting into, what are the ramifications, what happens if it doesn't go well, how are they going to be helped if it doesn't go well? Like all those different details that I believe get left out when you're rapidly building a platform or rapidly trying to grow a new product. and then we trip over ourselves. We've all done it, right? I mean, we both work in UX. Like we've had things where we had to go back and change, the way the product is developed to make it,
Yeah.
a little more
The
clear about
unintended
how something works.
consequences. Yeah.
Absolutely. Absolutely. And so, like, for example, gamification. That's a very big word there. There's a lot that involves in that. So reinforcing that you did something correct can be a great thing. So let me give you an example. So there was a company that I met with 10 years ago, and they gamified the information you fill out when you go to a doctor's appointment. So you know how they give you that clipboard and then ask you all those questions like, do you have diabetes? Do you smoke? Blah, blah, all that stuff, right? They actually gamified that because they had found that people weren't, one, filling out all the information. So then the doctor would have to ask you all these questions when you got in there. And number two is that people felt like uncomfortable doing it. So they created an app, and when you filled out your birth date, it like put up balloons, happy birthday, only 20 more days to your birthday, and like really fun stuff like that. And then they saw a much higher adoption of correct and accurate information that's going to help your doctor and help your healthcare providers better understand you so they can provide better service to you. I thought it was awesome, and it did really well, and people loved it, and they thought it was fun, and they'd have their kids help fill it out and that kind of stuff. Well, doing that in options trading doesn't transfer perfectly, right? Like if you do that in options trading, you might also just be making people super, super excited to dump more and more of the money they either have or do not have into the market. So you have to be very careful. I'm not saying you can't do a little bit of that, but I do think that there needs to be some regulation around how that approach is taken.
Well, I think it's going to be really interesting if we can find out how much of this is people are dumping money into the market that they don't even have. It's money that they've borrowed. And that's one of the things that you would see with like, not to conflate the two, but with gamblers, right? They'll take out a mortgage on their home in order to go out and gamble.
Yeah.
So that I think is one of the things, that's one of the areas where you start creeping towards kind of that 2008 collateralized debt obligation kind of territory, where now if the markets are potentially bankrupting large amounts of people, then you can have a real problem, especially because when the capital goes into some of these markets, it's taken away from markets for new goods and services. So there's like I said, people are spending less money on haircuts and movie theaters and these kinds of things. That means that those industries struggle in order to make this other industry flourish. It can have a detrimental effect, and that's also kind of starts to feel a little like 1929, like there's not enough money circulating within the economy in order to support normal businesses and keep people employed. Mm-hmm. But on the other hand, we've gotten to the point where it really is the only way in order to save for a retirement or the future. So it's kind of a catch-22, and we've got to find out the right balancing act. And I would hope that if it's not Robinhood, then apps like Robinhood would act responsibly in kind of their experience design, their product design, in order to get us to a good place societally.
Yeah, I would agree with you. I mean, with that said, like, where do you see all this going? Like, I know it's a really tough prediction, but I'm just curious on like where you see kind of the market and these apps and all that kind of stuff a couple of years from now.
Well, I expect some new regulation. I think there's gonna be some limitations on gamification. So, and I should clarify, some of this I think are going to be government imposed regulation, and some of this I think is going to be industry imposed self-regulation, kind of like how the MPAA has their rating scale, or the video game industry has their rating scale for like rated R, rated G, that kind of stuff. But I think we're going to start to see some limitations on access to some of these tools and some of this money. Unfortunately, I think that you probably won't see as much limitation on kind of the action of the institutions, because it's plainly obvious that some of this is, or quite a bit of this volatility, I should say, is actually a result of them kind of overreaching and playing fast in the rules loose with the rules. Like if the naked shorts had never happened, then it's unlikely that the rest of this would happen.
Hmm.
But there's not always the same kind of will in order to regulate them as there are kind of individual investors. And I think that we would all benefit from some of that being reined in a little bit. And then, as you kind of mentioned, like I think that like eliminating partial share purchases or severely restricting them in some way, those are all things that are going to it's going to tighten things up, because as long as these investment markets are really unpredictable, it makes it very difficult for anybody to really make money.
No, that's a great kind of outline of where you think things are going. I mean, for me personally, I think that we're going to move into this mandatory education certification area. I do think that if you're going to borrow money or you're going to start making big trades and stuff like that, they're going to have to ask you some questions, and you're going to have to be able to answer them to show that you have enough education or to make those decisions. And I think that's a good thing. I don't, a lot of people are like, oh, like you're putting barriers up to people, but I think it's good just to understand, at least from the platform perspective, that you understand the basics, you know what you're getting into. And then after that, we can let you make the decisions that you want to make. Right. But I think that's going to play into the experience of being a retail investor in the future. It won't be like terribly difficult or anything. It'll just make sure that the playing field is leveled when it comes to knowledge, just to make sure that everybody knows what they're getting into, right?
Yeah. And to be clear, that probably wouldn't have prevented something like the Robinhood event, but it would prevent some of these situations, like people getting into very bad spots with leverage or investing more than they really should in like an option they don't understand. And that's, I think, one of the biggest dangers. If we start seeing large amounts of younger people starting to get bankrupted by investments they didn't understand as much, then it can have a really serious impact on the economy at large.
Exactly. Well, I think this was a great episode. I think it was good that we dove into this because we're kind of right in the middle of it right now, with everything that's going on with Robinhood and the short selling and all that kind of stuff. And at the same time, it's highlighting product. It's highlighting that user experience and gamification and all these different things, they all play together now. And we even have a whole new group of investors that are coming out. And I'm actually excited to see what those investors will do over the next decade, right? As they age and get more educated and, come into the market from a completely different angle than you and I came in from. So for everyone who's listening, I want to remind you one more time, we're not telling you where to put your money or what investments to make. We just wanted to give everyone a lay of the land when it came to what was happening and kind of how we perceive it from the product side of things. Also, if you haven't already subscribed to the podcast, please do that. Tell a friend. We love it. We're growing all the time and we're really enjoying this. And we have many, many more episodes ahead of us. So thank you all. And we will see you next week.